Hello everybody, Luke Groman, founder and president of FFTT, Forest for the Trees, doing our weekly Periscope. Thank you for jumping on. Quick hello to everyone watching this on replay. Appreciate you taking the time to do so. As in keeping with the format we've been doing, seems to be working for a lot of people, we're going to run through the two things that have grabbed our attention recently pretty quickly here, ideally in 90 seconds or so, and then open it up for questions. I've picked up a couple questions actually already via Twitter, so I'll run through those as well. So first thing that grabbed our attention is we're finding many people and many investors are focused on the U.S. dollar shortage in particular, and rightfully so. The one aspect that it seems that few are focused on at this point regarding the U.S. dollar shortage and a metric of the severity of it are on the U.S. Treasury auctions. And what we mean by that is not last week but the week prior, there were three big Treasury auctions, a 2-year, a 5-year, and a 7-year, and all three of them, 3 for 3, they were sloppy and they had a big tail on them, which basically means demand was not necessarily all that great relative to the amount of supply. So the supply is starting to kind of weigh on driving rates higher. You're going to see some more big auctions coming this week and more supply, sizable supply in the second half of the year. Now, why I think this is important is one of the things we're watching closely this week is this week's auction and in coming auctions is the bid to cover rates and the tail on these auctions. And the reason I bring this up specifically is what happens to the dollar and the dollar narrative if we get either a really low bid to cover or a really big tail on one of these auctions. Because again, we have to remember global central banks have not bought Treasury bonds on net in 5 years. The United States private sector is the only major group of investors buying Treasury bonds at this point. And so they have a finite balance sheet. They mark to market. Most of them mark that balance sheet to market. And so they can't take losses infinitely like global central banks theoretically can. And so we're going to be watching this very closely as a metric on Treasury supply demand, but also very importantly on the dollar. You get a very low bid to cover or a very big tail. I think it could really be an eye opener. It'll be very interesting to see if we get one of those or both of those in either an auction this week or in coming auctions, given the size that's coming to market in terms of Treasury supply in the midst of Fed QT. I think it will be very eye-opening and very instructive as to how the dollar reacts to that, which I think is probably an eventuality, not really a possibility. The second thing I would highlight, something we tweeted today, a link to an article from Bloomberg 2 years ago, citing Goldman, a Goldman report or note that when the yuan fell against the dollar, Chinese physical gold demand rose significantly. And I continue to think, particularly in the context of earlier today, the article that the PBOC had cut reserve requirements pretty notably, which is a move to inject liquidity into the Chinese economy, and all else equal should drive a weaker yuan against the dollar. The thing or the side of this equation that I still see very few people paying attention to is the correlation between the weaker yuan against the dollar in particular and the rising physical gold demand. And obviously, the yuan could fall dramatically against the dollar in theory. There's sort of, dependent, and there's certainly calls for it to break through 7 and go beyond. The governor on that, which I do not think is well understood, may very well be the amount of physical gold in London in particular and also in New York. In other words, as the yuan falls, these vaults get cleaned out. And you've seen, we've talked about it ad nauseum for much of this year. This is a run on physical gold that is helped when the yuan falls against the dollar, or is helped spurred when the yuan falls against the dollar. And as we've said, none of this is going to matter until it matters. But when it matters, it could be very binary and political in nature. So those are the two things that really grabbed our attention. Before we jump into questions real quick, wanted to highlight again FFTT-LLC.com. If you can go over to our website, check it out, see what we're up to. I would encourage you to take a look at our tree rings product. It is a for a nominal fee. If you really like these periscopes, we do a top 10 most interesting things with some analysis of a variety of different stories or charts, and I think we tend to have a unique lens on the world, and we're trying to share that lens in a top 10 most interesting things list report. Like I said, a nominal fee for customer, nominal subscription price. So really trying to open that up to the to all investors, because I think it's a very very unique product. We've gotten great feedback on it. So check it out again, FFTT-LLC.com. So let's jump into questions here. I've got one from Hamish to start with that was put on our Twitter feed, talking about QT and the relationship with the dollar, Fed quantitative tightening. Bottom line, all else equal, QT is absolutely positive for the dollar. It likely is correlated in terms of the strength of the dollar with the Fed tightening, and certainly correlated with rates. The Fed shrinking the size of their balance sheet. To us, context, the broader context, I don't think it's that simple though, or increasingly not be as simple. I think you're going to need to start looking at what's the ECB doing. Are they tightening? Are they still loosening? I would think you'd want to start looking, as we've talked about, the U.S. fiscal situation, we think is becoming more and more important. And so it is not just a one-to-one. I think it's really a multifaceted dynamic, or increasingly multifaceted dynamic to take a look at as it relates to the dollar and Fed QT. So hopefully that helps, Hamish. Let's see what other questions we got here. Somebody hit me here at Magenti. Does the GLD cease to exist at some point, i.e. runs out of gold? Well, you guys are leading me off with a loaded question right from the start. I actually think it's a great question. If you look at the GLD prospectus, if you read it, it's if you have trouble sleeping, I'd recommend it. But in all seriousness, there is language that can be construed to be force majeure language. I'm told that that's pretty standard, either English or New York law. I don't know what, I think it's English law, but in terms of the language, but it's clearly force majeure type language in there. And when I say force majeure, some sort of cash settlement, if we can't get gold, etc., type of language. And I think that that's in there. It's probably a CYA type of inclusion, but it's in there. I would encourage as we watch the when I say none of this will matter until it matters. These are the types of things, though, that I'm referring to in terms of, look, there is today 730 tons of gold in the GLD. That number was, I believe, over 100 tons more about 3 months ago. And in theory, you're looking at a product that could, in theory, go to 0 tons owned and still have a pretty substantial market cap, and that's going to be that would be an interesting setup. The reality is I think you would more likely ahead of time see something, as an example, back in 2009, coming out of the worst of the financial crisis, it seemed likely to me that oil prices would rise pretty meaningfully, particularly once the Fed really ramped up QE. As well as you saw some global fiscal expansion, China in particular. It seemed pretty obvious that oil at the time, which was 35 or 38, would rise. One of the instruments I was playing in my personal account was a double long oil ETF, ticker DXO. And it was a great trade for about 3 or 4 months. And then I want to say around September of 2009, there was a press release that came out and said, basically we're taking this off the board and it'll close in a week and you'll get your money. And that was that. The DXO was gone. And so that is not making the case that's what GLD will do. I'm saying that if you have an unconstrained run on physical gold continue the way it has been in slow motion and over the past 5 years, by and large, there is at some point a finite amount of supply that they will be willing to let loose, and then you will have to do some sort of binary type of outcome like that. So, do I think it would go away? I do think I do think these are the types of things we could head towards if you run into more extreme financial situations. And like I said, I would point you back to that yuan dollar relationship, and that Goldman highlighted that when the yuan falls against the dollar, China buys a lot more physical gold. And once it's in China, it's not allowed to leave mainland China. So I'll stop there on that question. Let's see. Thoughts on the S-300 delivery to the Syrian government? Hi, Andrew. Good Monday morning to you. Thoughts on S-300 delivery to the Syrian government? Seems like a black swan in the Middle East coming. I will say I'm not an expert on the S-300 systems or the S-400 systems. What I try to do is put pieces together across a number of different sectors and silos. One such connecting the dots between different silos I have noticed has been every time the S-300 or S-400 is either bought or deployed somewhere, the United States government gets very angry. And I've been told that it's for good cause. I've been told it's the real deal in terms of a system, that it does do some very interesting and threatening things in terms of its ability to provide air defense relative to some of the things that call it NATO forces can do offensively. To me, understanding that from people that do understand those systems, then I look at this deployment of S-300s to Syria as, I guess as an escalation, as a statement that, look, this. We're going to take defending this airspace more seriously than we were prior to the deployment of these S-300s, and then I think that has informational value we have to start thinking about. Hi, Sundar, Columbus, Ohio. Good to hear from you. Wanted to ask if, like the February 18 bond sell-off before stock correction. To me, that I'm not sure I fully understand your question. I can't come up with another one, but I will say this: I thought the February 18 stock sell-off was very, very meaningful from the standpoint that U.S. Treasury yields rose in that sell-off, and that was one of the fastest 10% sell-offs in the S&P 500 in 100 years. And yet U.S. 10-year yields rose; they didn't fall. And to me, that was a very important indicator because when you look back to 2015, yields didn't rise; they fell, and that sell-off tied around to the yuan devaluation in August of 15. You go back to, I think it was 2010, was another quick 10% decline in the S&P, and again, yields fell. And so to me, there was a very big moment. That was the first time in a long time at least, where you saw yields rise into a sharp sell-off in U.S. risk assets. And I think that's pretty instructive in terms of a couple things. I think it speaks to this dynamic that we've been highlighting, that deficits matter again for the first time in call it 70 years in the United States. I think it ties into the dynamic that at 155% of GDP, U.S. equity market cap is incredibly important to U.S. tax receipts through consumer spending, and so if stocks fall, you're going to get a rapid increase in Treasury issuance as Treasury receipts fall. So, do I think what you're asking is this rise in yields, can it trigger a risk off? I think it absolutely could. To me, it's a question of how long. Understanding these other dynamics of you can't let stocks fall for very long, given how important it is to tax receipts, given how important it is to consumer spending. And as a result, I wouldn't be surprised if stocks do fall, if the dollar's down as stocks fall sharply, because I would suspect Mr. Market would start thinking, okay, understanding the structure of the U.S. economy, that we got to have rising stocks to support consumer spending and tax receipts. The Fed will, rescue that in a relatively short period of time. What assets would I want to own if my run on physical gold thesis is correct? I would want to own physical gold for starters. Like, I think I've said it before on these periscopes. I've said it on Twitter. I've said it elsewhere. I think physical gold is the subprime CDS of this cycle. In other words, I think it's going to do very little at best until something happens, and then in a relatively short period of time, it is going to outperform virtually all other assets. Beyond that, of course, I think the way to think about it is go physical gold. Gold will be moving back into the system as a reserve asset, and as you do that, now you're talking about a system that is more balance of payments centric. And suddenly, if you have a currency system where you're rating currencies based on a balance of payments basis instead of interest rate differentials, it's interesting over the last 30, 40, 50 years. You've had a currency system where the currency that has the biggest deficits and the lowest pile of reserves has the best currency. In the prior multiple centuries, almost contiguously, it was the exact opposite. It was the nations with the best trade position and the biggest pile of reserves had the best currency. And a balance of payments system would move us back towards that balance of payments system. A run up in physical gold or moving physical gold back into the system as a reserve asset at a much higher price would be introducing a new neutral settlement asset into the system. What this all means in plain English for the dollar is that it would be the dirtiest dirty shirt. Just not because we're bad, it's just by virtue of the way the system worked with the dollar as reserve. We had to run the biggest deficits to supply the world with the dollars we needed. Now, practical terms, what does this mean? It would mean probably a pretty big shift in terms of it'd probably be bullish for the United States overall, but within that there'd be a vicious sector rotation out of consumer finance driven names, government spending type names, and towards industrial, energy, intellectual property, software, semiconductor fabs, things like that. It's not just coal and oil that would do well. I think you take a very broad view of finite equity interests in not just commodities that you need to keep your house warm, but also commodities to run your phone, etc. So I would think those types of things would do quite well under a scenario where there's a more balance of payments driven system with a neutral settlement asset, which we think gold has some role in that. Random question: Do I think if Tesla fails to raise the money, we make that as the top of the market? But I'll say this: I think if capital is clearly getting more expensive, and for a number of different reasons, and so it is interesting to see models that are reliant on nearly free capital. People are beginning to sort of look at these, ask these kind of questions. If Tesla fails to raise, I won't speculate on whether I think they'll raise or not, and what that would mean for the market more broadly. But I do think that there is, as we see rates rise, these models that require large amounts of very cheap capital, they probably start to have a bit of a tougher time. Would I want to own the S&P 500 in the case of I'm assuming in the case of a binary increase in the price of gold driven by some sort of either physical run or whatever? Yeah, I would absolutely. I think if you take a look, and this is something we have repeatedly said in some of our presentations and public presentations, has been, if you graph the S&P 500 over the U.S. long bond ETF, TLT, so SPX over TLT, pretty much the second Trump got elected, that ratio began rising. It's breaking out to new highs. Even last week with the sell-off in stocks, it didn't really fall because the long bond was falling as well. Long bonds were falling as well at basically the exact same pace that the S&P was falling. And so to me, I think this dawning, the S&P over TLT is a real good gauge of understanding the U.S. has fiscal problems, and that in the next crisis, sort of what I've heard referred to as crisis alpha, quote unquote, probably better sought in equities, over versus sovereign debt, and in particular U.S. sovereign debt. And that's something is different this time in the U.S., but it's not different this time. It's been a long, it's been 70 years since U.S. deficits mattered, and they've mattered everywhere else in the world that entire time. And so some of the things we're seeing seem very strange, but for people, I think, that have been in other parts of the world looking at this, it's if you look at what's happening to some of the U.S. markets and U.S. sovereign debt markets in particular through those lenses, they start to look at least reminiscent, if not outright similar. Gold price in 6 months. If gold price in 6 months, if we get our, as we've said, you've got this sort of slow motion run on physical gold happening. And that won't matter till it matters. If it has mattered in T plus 6 months, then I think gold price is enormously higher. If it hasn't mattered yet, then I think gold probably has done very little. At best case, in the next 6 months, 1,200, 1,250, 1,150. We've referred to a pseudo U.S. dollar gold pseudo peg that's been in place for almost over 5 years now, going on 6 years. In the 1150 to 1350 range, and in the last 2-3 years, it's been more like 1150 to 1250, 1300. So if it hasn't mattered yet, quote unquote, then yeah, I don't think gold price does much in the next 6 months. What is your outlook on real estate in a possible long-term rising rates environment? I question whether we're going to get a long-term rising rates environment. I think rates are going to keep rising until something breaks, and when they break, I think they will be pinned at a politically expedient level by the Fed in a manner reminiscent of the BOJ, or reminiscent of what the Fed did during World War II, which was also the last time that the U.S. The foreign central banks weren't buying our treasury bonds, and the U.S. Debt to GDP was where it was. And so, to answer your question, in the near term, as rates rise, I don't think it's historically not been great for real estate, broadly speaking. But ultimately, when you look at the levels of debt that we're at, it comes down to this sort of contextual understanding that Western sovereigns broadly, the United States specifically, the level of sovereign debt, they've got to get written down on a real basis. The only way that can be done is with the currency. And so ultimately, I think broadly, a good framework for investing is understanding, okay, finite assets versus what will essentially become infinite assets. And treasuries and dollars can become infinite assets. And so sort of anything that is a productive real asset, I think will ultimately, be a good, worst case preserver of real wealth and maybe a grower of real wealth. Thoughts on the yen in the short term? One thing I will say on the yen, I don't spend a ton of time on it. The thing that I thought was really interesting is the United States started talking about bilateral trade negotiations with the Japanese last week, 2 weeks ago, 3 weeks ago. At any rate, I think it was either late 2 weeks ago, early last week. At any rate, the point is this: you had the yen up against the dollar, so a weaker dollar against the yen, and you had stocks up big, you had gold up big, and again, set aside gold, you had stocks up big in the U.S. Historically, yen up big is stocks down big. So what grabbed me about this was, as we're doing these bilateral trade deals, it seems possible that there are currency considerations, we'll say, to work towards a more balanced trade relationship with some of these places. And so I don't want to make too much of one day's, sort of 5-minute macro. I don't want to make too much of one or 2 days move in the yen up on the dollar, but it was interesting to me because, again, it is a very unusual move for the yen to move up against the dollar and for stocks to be up big. I think that was Tuesday of last week that happened. So that is one thing I'm watching. Where is it possible the historical correlations between the yen, the yen dollar and U.S. risk begin to break down as we're talking with the Japanese about some sort of bilateral trade deal that may work to balance trade a bit more. Let's see. So instead of 70% GDP is consumption in the U.S. post D-dollar, that will have to go down a lot. Let me slow down and reread that. So instead of 70% of GDP is consumption in the U.S. after a de-dollarization, that would have to go down a lot. I think it would have to go down in the near term, but I think what you're really talking about is an increase in nominal wages, right? So that actually, for the last 20 to 30 years, what we've had in the U.S. is debt-fueled consumption, right? Where we've moved jobs to China and other low-cost countries, and then we replace those jobs with lower wage jobs without benefits and a subprime loan to go buy a house and a car. And that all works until you get rates to zero, and you sort of need the bailouts we had in '08. If you actually start having nominal wage increases again that allow people to deleverage nominally, then ultimately that's a very good thing for the United States in total. It's a very good thing for the U.S. economy. It would be very good for U.S. consumption. It just wouldn't be good news for owning fixed rate instruments as that nominal wage growth, because of a weaker dollar, happened. Any thoughts on the Saudi-Turkish embassy situation? No, pass. I've been reading it, watching it. I'm gonna pass. Simple question: will gold futures rise equally to physical gold? Keep in mind, as physical gold collateral is pulled from the paper markets, all else equal, that drives gold futures to fall, not rise. That said, if you get some sort of reset type event or some sort of binary political event, however that's structured, to me, I think we need to look back to 2008 to understand would paper participate in that. And what I mean by that is, in 2008, AIG was selling mortgage insurance to a number of too big to fail brokers or banks, and AIG got bailed out at par. Because if AIG didn't get bailed out at par, then they would have defaulted on those commitments to those too big to fail banks, and those too big to fail banks would have begun failing. And so when we use that, and I set aside any sort of political feelings about that. It just is what it is. I think there's informational value to understanding that. And by that I mean, if the too big to fail banks are long paper and something like this happens, then I would suspect you'd probably see paper participate. The question is who's short the paper in that case. If the big banks are short paper long physical, I would expect that you probably see paper get closed. Paper gets settled at prior day's close, and the physical would participate wholly, based on our experience in 2008. You're welcome for the periscopes. I'm glad you enjoy them. Somebody said I would like to pet my bald head. That's let me see. Did I see the Deutsche Bank Jim Reed article on the inflation wave? I didn't see that. I will take a look for it. I apologize. So I just don't have not in a position to comment at this point based on it. But thank you very much, Dave. I'll take a look at it. What did I mean by China would need to hollow out their economy? Great question. If you are the reserve currency, and this is, I think, a really important question because it's something you hear. It's a bit of a straw man argument I see a lot, which is the yuan's not ready to overtake the dollar as the world's reserve currency, or the euro's not ready to overtake. And it's a straw man argument because neither of those countries want that. Neither of those currencies are structured in a manner to do that. And so what I mean by what China would need to hollow out their economy is, if a nation is going to have its currency be the sole reserve currency, if their sovereign instrument is going to be the primary reserve settlement asset, treasury bonds in our case, what that ultimately implies is you're responsible for supplying the world with the dollars you need, or the world needs, to conduct trade. And so for us, what that meant was, we offshore all our. You have to run these large government deficits, and as you run these large government deficits, you need to, you basically end up having sort of a government and debt fueled spending party in the near term that you end up, for lack of a better word, insolvent or bankrupt or requiring monetization in the long run. And that's Triffin's dilemma in a nutshell that I just described. When I say China would need to hollow out their economy, Chinese government would have to start running enormous deficits, and then they would have to start effectively offshoring their manufacturing production to aid in their, to basically aid in their government's ability to run these massive deficits. And from a political standpoint, from a national security strategy standpoint, as far as we understand, there is less than zero interest in China doing either of those things. So, if you look, the reserve status of the dollar, the reason manufacturing has left America in no small part is that was sort of part of the deal. It was, you take our factories and our jobs, and then we give you dollars, we export dollars to you to make stuff and send back to our markets, and then you recycle those dollars into our financial markets. And so that's what we mean by need to hollowing out their economy. Basically, for China, for the yuan to be the reserve, structured the same way as the dollar, they would have to basically do what has happened to the U.S. Rust Belt over the last 30 years. And there's just no way they're going to do that, in my opinion. Let's see. What, if any, thoughts do I have on the uranium sector for energy production with oil prices over 70? It's a great question. I've not spent a lot of time thinking about that on uranium. It's not something I've spent a lot of time with, so I don't want to misspeak there. I'll have to start looking at it. Misspeak on uranium. Let's see. Does China ever have a bona fide Minsky moment, collapse, or social unrest? I think it's entirely possible. I think it's entirely possible. The thing I wrestle with a little bit is I think they have a lot more leeway to deal with something like this than other places. And I'm not going to make a point about. This is not a political statement. This is a economic statement. So the real politic analysis. China doesn't have to be politically correct. And there are times when that is a problem. There are times when that is a big advantage. When you talk about social unrest, that's a big advantage. Can they have a Minsky moment? Absolutely. But I think between centralized control and the ability to in a pinch, China could basically, bulldoze over all the ghost cities they've built, the quote-unquote ghost cities they've built over however many years, and, reportedly a number of those have filled up quite nicely, but you could basically move the people out, bulldoze them down, restart over, and kind of keep the whole thing going, and that's, when you look at the structure of who owns the equity in the banks and who owns the equity in the state-owned enterprises, and who, you end up they're just accounting entries. So there's, it would be an interesting discussion to have of, can they ever have a truly bona fide Minsky moment? To me, the answer is yes, if they do not get the ability to print yuan for commodities, and in particular energy. If that's the case, then they're looking at going the way of the USSR. If they gain the ability to print yuan for oil, and that's why we've said this all along, this is such a big deal. Then I don't think they ever, they become the second nation able to do that, and I don't think they have the ability to have the same kind of Minsky moment, because you can always just roll it forward on paper, and you'll still have the physical commodities coming into your economy that you need to keep it going. Is paper gold pegged to the SDR? Excellent question. I do have one of my best relationships on the street who's been watching that and kind of highlighting to me that that there's been a pretty firm floor. I don't know about peg, but floor on the SDR to gold. I've not spent as much time with that, but I really respect the guy who's mentioning that to me, and so that would certainly be. I think it's important to watch. Let's say that. Are gold miners a better buy than paper gold if one does not plan on buying much physical? I the short answer to, if a gun to my head, yes. I'm not convinced the relationship between gold miners and physical gold will hold the way they did in the 70s or even in the 30s. Given if gold is moving back into the system as a reserve asset, then you have to start thinking about gold miners as sort of merchant banks, not gold miners. In that scenario, I think they do really, really well, but I think some of that upside in gold prices transferred to the government in which they're located, depending on where they are, etc. But I'm sort of thinking out loud with that one. I would rank number 1 physical gold, number 2 gold miners, number 3 paper gold. I would much rather own physical than gold. I would rather own physical than gold miners if I had no exposure. I would rather own gold miners than paper gold if I had no exposure. Let me put it that way. Let's see. Do I think China and USA will have a shooting war if there's no backing off in the trade war? Look, I'm the father of 3 boys, one of whom turns 18 next year. So it's I'd be lying if it's not something I think about with a certain degree of hesitancy. Is it possible? Yeah, it's very possible. I think if you read Thucydides' Trap by Graham Allison or some of the articles about it, in fact, I believe Kyle Bass just interviewed him on Real Vision, Graham Allison, that is. If the situations happen 12 or 14 times in history, and 3/4 of the time that the rising and falling powers have gone to war, it's possible. But talk about a situation in which there truly are no winners. Look, the Chinese capabilities would be revealed very quickly. We'd see if they've made as much progress as we think. The United States economy would hyperinflate almost instantly. Shelves would go empty almost instantly. It would not be a good scenario. I still place a very, very low likelihood of that happening, only because the logistical side, logistically, China would seem to be in a better position than the U.S. at this point. When you look at supply chains, look, China's got factories. They can create infinite amounts of credit with keystrokes on a computer. The United States needs more lead time to relocalize supply chains in those cases, because the Chinese aren't going to ship iPhones if we're at war with China. So that's sort of how I've thought about that question. But like I said, I think it's a very, very remote possibility. Thoughts on a crash in the next 30 days? Don't know. I've had some smart people say to me, "Hey, it looks, the falling stocks, rising rates is reminiscent of '87." I actually still had hair in '87. I was not in the markets at that point. So I just, I would defer to other people on that question. So it looks like we're running out of questions. Yeah, indeed, a lot of great questions today. I appreciate you guys staying on. I'm going to jump here. Oh, hold on, one last one. Could North Korea pact be the tool/prize for reaching a trade compromise agreement? Maybe. I've heard, from people in a more informed seat than I that Xi in China has been a much bigger driver to what has gone on in North Korea than our own government, or at least equal with our own government in terms of making that progress. So, I don't know. It's a very interesting question. It certainly could be the case. So. All right, guys, I'm going to jump here. I appreciate everyone checking in. It was great to have this many questions. Have a great night, and good luck this week, and we will see you guys next Sunday night. Take care, everybody.